Welcome back to the channel. Today, we're diving into the world of high finance, specifically hedge funds. Hedge funds can seem complex, but they're just investment funds with different structures and strategies designed to make money. We're breaking down 8 common hedge fund structures, explaining how they work, their advantages and disadvantages. By the end of this video, you'll understand how these financial powerhouses operate and the strategies they use. Whether you're an aspiring hedge fund manager, an investor looking to diversify, or just curious about finance, this video is for you. So grab a notebook, get comfortable, and let's get started. Let's kick things off with the single manager hedge fund. Think of it like a small business, where the owner is also the main operator. One brilliant mind, the hedge fund manager, calls all the shots. They control the fund's investment strategy, deciding what to buy, when to sell, and how much risk to take. The beauty of this structure is its simplicity. There's a clear vision, direct accountability, and investors know exactly what they're getting into. When a single manager excels, their fund can see serious returns. But if that manager's strategy fails, the whole fund suffers. Imagine a single manager fund focused solely on tech stocks. In a tech boom, they'd thrive, but during a downturn, ouch. The single manager structure allows for quick, decisive action without bureaucracy. This can be crucial in fast-moving markets. Plus, with a single manager, there's often a strong alignment of interest between the manager and investors. The manager's own wealth is tied up in the fund's performance, leading to a greater focus on returns and capital preservation. It's all about weighing the risks and rewards. Now, let's move on to the multi-manager structure. Think of this like a team of all-star players, each with unique skills and strategies. Instead of one manager, you have a team of specialized managers, each responsible for a portion of the fund's capital. One might excel at picking stocks, another at bonds, and another at real estate or commodities. The idea is to diversify the fund's investments across different asset classes and strategies, reducing risk. This sounds great, right? You're not relying on a single manager's expertise. But there's a trade-off: higher fees. More managers mean more salaries, bonuses, and expenses, which can eat into returns. Coordinating different managers and strategies can get complicated. Imagine trying to get a team of headstrong chefs to agree on a single menu. However, when done right, a multi-manager structure offers built-in diversification and more consistent returns. By tapping into multiple managers' expertise, the fund can capitalize on a wider range of market opportunities. If you value diversification and can handle slightly higher fees, the multi-manager structure might be worth considering. Just do your due diligence on the managers involved. Let's talk about the master feeder structure, often linked with tax efficiency and offshore investing. Imagine a main investment fund, the master fund, where all trading and investment decisions happen. This master fund is typically set up in a tax-friendly jurisdiction, like the Cayman Islands. To access the master fund, you have smaller feeder funds in different countries. Think of feeder funds as pipelines channeling investor money into the master fund. Investors from various regions invest through local feeder funds, which pool their money into the master fund. This setup allows the fund to attract global investors and potentially reduce its tax burden. However, tax laws are complex and constantly changing, so consult a tax advisor before making decisions based on tax implications. The master feeder structure isn't without drawbacks. Multiple layers of funds and fees can get complex, and there's potential for regulatory scrutiny. For investors seeking international exposure and potential tax advantages, the master feeder structure can be viable. Just understand the fee structure, tax implications, and the master fund's track record before investing. Let's dive into the fund of funds structure, or the hedge fund of hedge funds. It's like building a diversified stock portfolio, but instead of picking stocks, you're picking different hedge funds. Fund of funds act as professional fund pickers, selecting and investing in a portfolio of other hedge funds. The idea is to create a diversified portfolio of hedge funds for smoother returns over time. Diversifying your hedge fund investments can help mitigate the risk of any one fund blowing up your portfolio. However, there's a catch: fees. Fund of funds charge additional fees on top of the underlying hedge fund's fees. These fees can add up and eat into returns. For investors who value diversification and want exposure to hedge funds without doing all the research, a fund of funds can be worthwhile. Just understand the fee structure, the fund of funds manager's track record, and the underlying hedge funds they're investing in. Let's talk about the side pocket structure, which manages risk and protects investors from illiquid assets. Imagine you're invested in a hedge fund that's generating consistent returns. The fund manager makes a big bet on a promising but illiquid asset. Illiquid assets can be difficult to sell quickly without taking a loss. To protect existing investors, the fund creates a side pocket. Think of the side pocket as a separate compartment within the main fund for these illiquid assets. New investors don't get a piece of these assets, ensuring that those who took the initial risk benefit if the assets pay off. The side pocket structure can be controversial, with some arguing it creates a two-tiered system. However, if used transparently and judiciously, it can be a valuable tool for managing risk and ensuring fairness. Just be cautious of funds that use side pockets excessively or opaquely. Let's explore offshore hedge fund structures. Offshore structures, while often associated with tax advantages, aren't inherently illegal or unethical. They're a way for funds to operate under different legal and regulatory frameworks, offering certain benefits. By domiciling in jurisdictions like the Cayman Islands, hedge funds can potentially reduce their tax burden and operate with greater flexibility. For investors in high-tax jurisdictions, investing in an offshore hedge fund can lead to tax savings. However, tax laws are complex and vary by country. Offshore structures often come with perceptions of secrecy and lack of transparency. While not inherently secretive, the lack of stringent regulations in some offshore havens can raise concerns. The decision to invest in an offshore hedge fund requires careful assessment of risks and rewards. Consider factors like transparency, investor protection, and the fund's track record before diving into offshore investing. Let's unpack the Series LLC structure, popular in the US for its flexibility and risk management. Imagine a traditional LLC divided into multiple self-contained units, or series. Each series operates independently with its own assets, liabilities, and investors. Think of it like a building with multiple apartments, each with its own occupants and lease agreement. Each series in a Series LLC has its own investment strategy, assets, and investors, shielded from other series liabilities. If one series fails, its creditors can't go after the other series assets. This provides protection and risk management, attractive to hedge fund managers and investors. The Series LLC structure is relatively new, and its legal interpretation varies by state. This can create uncertainty, so experienced legal counsel is crucial. Despite its novelty, the Series LLC structure is gaining popularity for its flexibility, risk management, and potential tax advantages. Let's explore the umbrella structure, popular in Europe. Imagine a giant umbrella sheltering multiple sub-funds, each with its own investment focus and risk profile. Under this structure, multiple sub-funds coexist under a single legal entity. This allows for centralized administration, streamlined regulatory compliance, and potential cost savings. The umbrella structure offers advantages for investors seeking diversification and ease of switching between strategies. You can move your money between sub-funds without significant tax liabilities. However, managing multiple sub-funds requires robust risk management and compliance. Regulatory issues affecting one sub-fund could impact the entire umbrella entity. Despite these challenges, the umbrella structure remains popular for its convenience and potential tax efficiency. It offers a way to diversify portfolios and access various investment strategies under one regulatory roof. There you have it, folks. We've navigated the intricate world of hedge fund structures, from single manager setups to offshore entities and umbrella funds. Understanding these structures is key to demystifying hedge funds and making informed investment decisions. Whether you're an aspiring hedge fund manager or just curious about finance, we hope this video has shed light on the strategies and structures driving the hedge fund industry. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial insights. Until next time, stay informed, stay curious, and keep crushing it financially.